Hello and welcome to this session in which we will discuss the transition tax. What is the big idea behind the transition tax? Well, the transition tax is to do what? The purpose of it is to make it easier to shift from a worldwide tax system to a territorial tax system for US corporation with foreign earnings. Foreign earnings means what? It means companies that are operating overseas. What happened under the previous worldwide system, tax system? Under the previous system, US companies were taxed on their global income, but they could defer this taxes by doing what? By not bringing back the money to the US. So they can defer taxes on that foreign income. So if they don't bring it back to the US, we can defer the taxes until we do so. And what did this lead to? This led to US corporation operating overseas keeping large amount of earnings overseas to avoid high taxes. So if you are a USA company and you have a foreign subsidiary in Europe and you have earnings over the years, maybe billions of earnings that you did not repatriate. Now what you have to do is you have to bring it back to the US and pay taxes on it because we changed the rules. Well, what's going to happen is this. To ease this transition, to ease this shift, we're going to give you a one-time transition tax. So the transition tax serves as a one-time tax on these previously untaxed foreign earnings. Obviously, they are previously untaxed because you only get taxed once, regardless of whether the earnings are actually repatriated or not. So whether you bring back the money or not, we're going to charge you this tax. And this is what we will discuss, the details of this transition tax. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
So, under the Tax Cuts and Jobs Act, it introduced a significant shift in the tax system for certain US companies with foreign operation. So under the new system, as I just mentioned, US corporation can do what? They can fully deduct dividend received from their controlled foreign corporation. Simply put, it means they include it, then they have a deduction, so that the tax effect is zero on them. This means US companies are taxed only on their domestic income, not on their foreign income. But what happened for money that has not been previously taxed? Let's assume you've been operating in Europe for the past 20 years and keeping $50 million in profit that you have not brought in. Now it's going to be taxed. So to transition to this system, there's a one-time requirement for US shareholders who own at least 10% of the controlled foreign corporation to pay taxes on the foreign earnings that has not been previously taxed by the US. Because if it's taxed, you don't have to worry about it. This is known as a one-time deemed repatriation tax. And this tax applies to what? To the last tax year that begins before January 1st, 2018, and target the accumulated untaxed earnings of the controlled foreign corporation. So they would look at your untaxed earnings prior to January 1st. It means as of December 31st, 2017. They would look at how much earnings you have untaxed, and they would say, okay, now there's a one-time tax on this earnings. Now, just FYI, there's an exception for S corporation, a special type of corporation that meets Internal Revenue Code. You should know what an S corporation is. They can defer this one-time transition until certain triggering event occurs, such as the liquidation of the S corporation, the cessation of its business, or the transfer of its stocks. Why? They want to give more flexibility for US S corporation in managing their tax obligation during the transitional period. Now, let's go back to this one-time tax. What's the tax rate? How much do you have to pay? Well, the untaxed earning of the CFCs are categorized into two distinct types for tax purposes. So what they say, we're going to have different rates. If you're holding cash and cash equivalent asset, which is liquid asset that are easily convertible into cash, earnings falling under this category are subject to 15.5%. And the rationale behind this higher rate is that the cash and similar asset can be readily accessible and can be repatriated more easily, and that's why it's taxed more heavily. Well, what happens if you have non-cash earnings? Well, this category encompasses all forms of earnings that are not in cash and cash equivalent. They could be like if you reinvested in real estate, property, plant, and equipment, and other non-liquid asset. Those assets earning in these categories are taxed at a lower 8% to reflect what? The recognition that these type of earnings are not easily accessible as cash. Well, guess what? We're gonna charge you a lower tax rate because you really cannot pay us with property, plant, and equipment. To do what? To significantly reduce your expense. Because what? Because you cannot sell them easily. So therefore, the tax is 8%. So 15.5% on cash and cash equivalent, 8% on non-cash earnings. Now, do you have to pay this up front? Well, to make it easy for you, there's an installment plan. So let's assume, just for the sake of illustration, you only have cash and you have 100 million in cash. 100 million, and we said it's 15.5%. It means you have to pay $15.5 million dollars. Do you have to pay this at once? And the answer is no. You can pay 8%, 8% year 2, 8% year 3, 8%, 8%, 15, 20, 25. Obviously, they're giving you a break for 5 years, and they want their money. The government wants their money in the last year 6, 7, and 8. Kind of basically they come up with 15, 20, and 25. So you have some time to figure things out so you can bring back this money. You pay taxes gradually. Let's take a look at this multiple choice questions from farhatlectures.com. What is the primary purpose of the one-time transition tax imposed by the Tax Cuts and Jobs Act on U.S. shareholder? So what's the purpose of it? Well, is it to penalize U.S. corporation for keeping profit overseas? Is it to penalize? There is no such thing. They're not trying to penalize you. To transition the U.S. tax system from a worldwide system to a territorial system? Yes, because the new system is a territorial system. It means I'm going to tax you on the U.S. earnings. You can bring it from overseas, the dividend. I'm going to give you a deduction for that. Therefore, you don't have to pay taxes. B looks like a good answer. Let's look at C. To increase the overall tax revenue from foreign operation? That's not going to increase the overall tax revenue from foreign operation. Not necessary. To eliminate the need for U.S. corporation to file foreign tax credit? No, you could still file foreign tax credit if you pay taxes overseas, so that's not the answer. Therefore, the best answer is B, is to transition the U.S. tax system from a worldwide system where you could have deferred this money until repatriated to a territorial system where you can bring it back, we'll give you a deduction, but any previously untaxed amount is taxed now. So the answer is B. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you are studying for your CPA exam, accounting courses, enrolled agent, or any other professional certification. Invest in yourself. Good luck, study hard, and of course, stay safe.